On March 3, 2026, global markets witnessed an extreme anomaly. Stocks, bonds, and gold plunged simultaneously, with only crude oil and the US dollar strengthening. Cash became the single consensus destination for capital. The root cause was an unexpected escalation in the US-Iran conflict, combined with extreme position unwinding and a repricing of Fed rate cut expectations, triggering a cross-asset value-at-risk shock. Markets shifted from risk-off mode to liquidity-first mode. The intensity of the US-Iran confrontation exceeded expectations. Trump threatened to strike Iran at any cost, while Iran continued attacks on Gulf energy facilities and tankers in the Strait of Hormuz, posing a credible blockade threat to the waterway that handles 1/5 of the world's oil and LNG shipments. The market's previous optimism for a quick resolution has collapsed entirely, with geopolitical risks escalating from short-term disruption to a sustained supply shock. Energy supply chain alarms are sounding. Brent crude jumped nearly 7% intraday. Goldman Sachs raised its European natural gas price forecast by 50%, reflecting an estimated 20% drop in Middle East LNG supplies. Surging energy prices have become the core pressure point across all markets. This rare synchronized sell-off is a liquidity squeeze triggered by the confluence of three factors. First, a policy repricing. The window for rate cuts is closing, causing a simultaneous rout in stocks and bonds. Estimates show that every $10 increase in oil prices would add roughly 28 basis points to U.S. CPI. If prices stay elevated, May CPI could return to 3.0%, completely dismantling the case for Fed cuts. Consequently, the two-year Treasury yield hit 3.599%, its highest since late January, and the 10-year climbed to 4.06%. Higher rates punish richly valued growth stocks and long-dated bonds. The S&P 500's 22x PE is already elevated, and the energy shock is weakening growth expectations, putting equities under pressure from both valuations and earnings, triggering a systemic pullback. Second, crowded positioning and a VAR shock triggered indiscriminate selling across assets. Since January, positions in gold, crude, and the dollar had become extremely crowded, with volatility unusually low. The escalation in the Middle East triggered a mass unwinding of those positions, inflicting severe value-at-risk shocks on portfolios. The negative correlation between stocks, bonds, and gold broke down, rendering traditional diversification strategies useless, as capital fled all asset classes. After gold broke below key support, it triggered a wave of stop-loss orders, creating a negative feedback loop of selling, stops, more selling. Gold fell over 4% in a single day, with silver down nearly 9%. Third, surging demand for liquidity has pushed the cash is king logic to the forefront, with gold becoming a liquidity ATM. Global money market funds saw inflows of $47.9 billion on Monday, the highest since February 17th. In contrast, U.S. equity funds saw outflows of $9.6 billion, and global stock funds lost $9.1 billion as investors shed assets seeking liquidity. Gold had rallied nearly 28% in the preceding period, with speculative long positions at elevated levels. As geopolitical sentiment cooled, investors took profits en masse. At the same time, the stock market decline triggered margin calls, forcing investors to sell gold for cash. The dollar, benefiting from its liquidity and payment advantages, became the ultimate safe haven, hitting multi-month highs against the euro, pound, and yen. Looking ahead, three key windows bear watching. The status of shipping through the Strait of Hormuz. Whether a real blockade occurs and its duration will directly determine oil prices and market sentiment. The March 19th FOMC meeting. Watch for mentions of geopolitical and inflation pressures in the policy statement, and the dot plot's implications for rate expectations. And fund flows. Sustained inflows into money market funds and the scale of outflows from gold ETFs will signal the severity of liquidity strain. On investment strategy, in the short term, 1 to 2 weeks, stick with cash, reduce exposure, and add to energy and defense sectors while avoiding airlines, travel, and richly valued tech stocks. In the medium term, 1 to 3 months, after the conflict de-escalates, inflation cools, and the S&P 500 pulls back more than 10%, gradually build positions in defensive sectors and AI names with earnings delivery. The core risk to watch: a prolonged blockade of the Strait of Hormuz pushing oil above $100, triggering global stagflation and potentially forcing the Fed to resume rate hikes. This rare synchronized decline across asset classes is fundamentally a liquidity squeeze and policy repricing triggered by geopolitical conflict, not traditional safe haven logic. Cash's dominance reflects the market's extreme defense against profound uncertainty. In the coming week, the status of shipping through the Strait of Hormuz is the core variable. If the conflict does not escalate, markets may gradually recover. An extreme supply disruption would trigger an even larger scale adjustment.